Our second panel is going to cover Europe outside the euro area. We're going to switch up the order a little bit. We're going to start with Julian Callow. Julian has to run off to CNBC. We're very happy to have him do that because we're hoping he'll mention us on the TV. So he's going to go first, then Katarzyna Zajo-Kurowska from the National Bank of Poland. She's on the board there. And then Michael Morisi from JP Morgan will be speaking. Michael is on his way here as we speak, so we're going to go one at a time rather than having the panel because we'll have people moving in and out of the room. With no further ado, Julian Callow.
Thanks very much, Michael, and let me extend my own welcome to London, my home city. I'm sorry the sun is not yet shining. Maybe it will make an appearance later on today. Being in London, it's entirely appropriate that this session, which is going to be on the implications of QE, does focus very much on the UK experience. And so I'd like to give you some of my own personal perspectives on how QE has been affecting the UK economy and, more importantly, of course, what this might mean for the future. So, to begin with, we must, of course, realize, I'm sure we all do, that the UK went into the great financial crisis, the Great Recession, with very high levels of debt. There'd been very rapid accumulation of debt in the private sector, as you see shown here, really since the late 1990s. And this was particularly intense going up to around 2008, where you can see that in relation to GDP, the household debt had got up to over 100%. The non-financial corporate sector debt was a similar share of GDP. And the consequence, really, of the Great Recession, the financial crisis, has been significant deleveraging coming through in the household sector and the non-financial corporate sector. You can see that, I think, quite clearly on the charts, such that the household sector debt-GDP ratio is now running at about 90%. And actually, it's quite interesting in the context where there's a lot of discussion about the UK housing market boom, that we're not actually seeing a lot of growth in mortgage credit. And so a lot of discussion you'll be aware of, I'm sure, it's in the papers today, that the Bank of England has to start using measures to dampen down house prices. But at the same time, it's not necessarily a bubble because we're not seeing very excessive rates of credit growth. I think that will probably come unless policies get altered fairly soon. But it's important to note we're not there yet. And at the same time, as we'll see in a moment, the non-financial corporate sector really has been very aggressive in terms of bolstering its saving, cutting its debt since the financial crisis. But this is something you see really for most economies, perhaps even more so for some, I could think of, that if you add together then the public debt as well as the non-financial private debt, you come up with a ratio that is relatively steady, hasn't really come down at all since around 2008. So the public sector debt ratio has been expanding very significantly and is now at about 90% of GDP on the Maastricht basis. And there are still challenges related to that. Now, as we know, the Bank of England had a very aggressive program of asset purchases, but at the same time, it stopped the asset purchases much earlier than the Fed. And this is a really important point, I think, that there's so much concern about how the Fed will taper, what it might mean. We had this incredible disruption we're all familiar with in the financial markets during the spring of last year. There was a great speech by Jeremy Stein a couple of days ago looking at this and how the Fed should communicate. Now, if I understood him correctly, he was saying, well, you know, the central bank just has to be clear above all, and if it's going to change course, it mustn't hesitate, it mustn't be too incremental. It must just really go out and do it with a very clear framework. And you know, I think that's quite interesting when we think about the UK experience, because the Bank of England stopped QE, and there was certainly quite a significant minority on the MPC who occasionally wanted to do more QE, and quite often we had calls for that. But the Bank of England did stop effectively in the middle of 2012, and since then the economy has actually prospered remarkably well, as we'll see, and that is very interesting. There may be some specific UK features. As I emphasised, it's not actually a credit boom at the moment that's driving it. It's actually something much more underlying, something more micro, something to do with the performance of the non-financial private sector. At the same time, during this strategy, we can observe, of course, that the very rapid interest rate reduction, you could say as well, perhaps, it's a little bit historic now, but having lived through it, I remember it only too clearly that the Bank of England was actually tightening monetary policy in 2007, even though alarm bells were beginning to go off in the money markets. And then we had a very, very dramatic interest rate reduction. But also of interest, the Bank of England has kept its main policy rate at 0.5%. And again, that policy seems to have worked reasonably well. I'm then highlighting on the chart what we can see from forward interest rates, both in real terms and inflation terms. And you can see that the inflation series, which is the purple-coloured line on the chart, is actually relatively well behaved. You could argue this looks a little bit on the high side, but it's still relatively well behaved, a bit volatile perhaps. And then the real forward yield is remarkably low. And that's actually quite different to the US experience, where of course real forward rates in bond markets rose very, very sharply by around 100 basis points or more during the period from May through to September of last year. And that had huge knock-on consequences for other markets, such as EM debt markets. Yet we haven't really seen that in the UK. And I think, in turn, that is probably due to some specific local factors here. In other words, what is happening in terms of large financial institutions and their appetite to take on bonds. Partly it's the banking sector as it builds and builds and builds and builds its capital, and partly as well it's what's going on, of course, with the pension funds, with the ageing society. So perhaps some specific features there that are keeping the real interest rates extremely low in the case of the UK right now. But anyway, we've got through so far without any great hardship the rather abrupt end to asset purchases. There wasn't really a tapering effect there. And we have seen a consequence in the currency. It's starting to rise. The currency, you couldn't really say, is especially overvalued if you do a chart like this, where you just look at it in relation to its long-term history. So the real exchange rate, which is a very broad measure deflated by unit labor costs, has started to move a bit higher, but certainly nothing like as overvalued as it was really for the 10 or 12 years between 96 and 2008. Sorry, the real exchange rate, I should say, is the blue line, and the red line is the nominal one. But either way, the message is really quite a similar one so far. I think this is also important when it comes to the way the Bank of England is assessing the situation, because really in the UK many people think in terms still, at least those of a certain age do, of the so-called 4-to-1 rule, which is basically that a 4% movement in the trade-rated exchange rate is equivalent in terms of its impact on the economy to a 100 basis point rate increase. And in fact, we've had about an 8% gain in the UK trade-rated exchange rate in the last year. So that's like a tightening of 200 basis points on that rule. And although it's a very vintage rule, I've never really seen anyone convincingly deny it from the Bank of England, so we could assume that it's a little bit still implicit in their models there. So we are getting now a recovery. It was looking quite lackluster in 2012. Personally, I don't really trust the ONS statistics, and neither does the Bank of England. The Bank of England actually publishes its own estimates of what it thinks historic GDP has done, which is 2 to 3 tenths stronger growth rate in recent quarters than the actual official ONS statistics, because the Bank of England assumes that the numbers will eventually get revised up. And I think there are big issues in terms of how you measure UK productivity. If you look at it sector by sector, you find that in many of the non-financial service sectors, there's very weak productivity, according to the official numbers, such as in the IT and business sector, which doesn't really seem to gel with what's going on the ground. I mean, my view a little bit would be, well, if productivity is so bad, then why are companies hiring? Why is employment growing so fast in the UK? I know part of it's self-employment, but also employees are growing fast. Are companies really that stupid, not realizing what productivity is? I don't think so, frankly. I think you have to be pretty smart if you're running a company in a very tough environment. And in fact, if you look at what is series I've created here, which I call non-financial private sector GDP, the red line. So the idea is to try to strip out the impact of the retrenchment by the government sector and also the retrenchment, it must be said, by the financial sector. Then you come up with a series which is showing noticeably better growth than the headline real GDP numbers are doing, and is actually already growing a little over 3% in Q4 year on year, compared with about 2.7 on the official GDP measure. So there is something going on in terms of, I would say, a recovery driven on microeconomic foundations in the real non-financial business sector, in the private sector, that is, in the UK. Of course, it's accompanied by some rather crazy house price gains in certain parts of the southeast. That's true. It's also nowadays being encouraged by the fact that government's no longer in fiscal retrenchment mode. But it's also encouraged by the steps that were taken to improve the financial sector, the fact that credit is starting to flow around in the UK. And I think it's also, most of all, a tribute to the underlying flexibility of the UK labour market. Meanwhile, inflation does remain very subdued. And, you know, I used to think, well, UK inflation was a real problem here, and I would often be at a dinner, and after a certain time in the dinner, you know, maybe 1.5 hours into it, and a sufficient wine had flowed, and regardless of what the notional topic of the dinner was about, people would start attacking the Bank of England for losing credibility over how it had lost the fight on inflation here. And you can see with the headline inflation rates, I mean, we were getting up, we had these twin peaks, in fact, and we got up to over 5% on a couple of occasions. I actually then set about calculating what I call a core CPI, my own version of it, where I'm excluding volatile components. So what I'm doing here is taking out really the usual suspects: food, energy, tobacco, beverage. And I also exclude administered prices from this, and also transport services, I'm afraid, because airfares are hopelessly volatile. So I just want to get along to the core, and you might say, oh, Julian, you know, you're excluding everything, and I guess I'm excluding about 45%, so you don't have to take it if you don't want to. But the interesting thing is that core inflation rate has been very, very steady and moderate, I would say, is currently running at just 1.3%. In March, and the headline rate is starting to converge down to that. So a lot of the inflation we've had in the UK, and it has been formidable, it's been things like student fees, it's been significant energy prices as the UK attempts to become a somewhat greener economy. It's also been, to a degree, food prices going on. Tobacco taxes keep getting raised sharply, and the tobacco manufacturers then think that they might as well raise their own margins at the same time. So you've got a lot of other factors that have been pushing up inflation, but you strip out some of those that are more driven by the public sector and by commodities, and you find underlying inflation is actually really quite subdued here in the UK, which does give the Bank of England some breathing space as the most likely chorus of demands from people who want to focus on it will be that the Bank of England is getting behind the curve. The FT had a bit of a dig in that direction today, I saw. So you can then look at what's going on in terms of adjustment in the economy, and this gets us back really to the first slide, which was looking at debt ratios. Here we're starting to look at the flows, and I've always find this analysis quite relevant, really, for understanding where the risks are in an economy. You can see there's been a lot of sectoral adjustment going on. So the green bars, that are maybe the most prominent, that's the government deficit. And in seasonally adjusted terms, for Q1 of this year, it was about 6% of GDP. So still significant, thankfully, well below where it was at around 12% of GDP back in 2009. So there's undoubtedly been a lot of structural fiscal adjustment, which is, you could say, roughly speaking, of the order of 6% of GDP in the UK. But in fact, the UK is emerging with one of the biggest budget deficits, really, of any major economy. And it's going to have to do more work in this direction after the next election, not before, but definitely a challenge for the next government. At the same time, there has been, from the household sector, which are those, I guess, pink-coloured lines there, you can see that it went into a financial surplus, which it hadn't been in for about 10 years, around 2009. It's starting now just to run a slight financial deficit. So it's starting to rely a little bit on external capital here, which is not such a healthy sign. It's very slight, the impact right now. And then the blue bars are for the financial corporations and non-financial corporations. And what you can see is really that they've been running a very large surplus. It's really since 2000 or so. And it's a bit like that in the case of the US. You find the non-financial corporate sector in the UK runs a very, very large savings surplus. And it's been a bit of a mystery, although we're beginning to realize that actually part of the secret to understanding it is that this includes pension contributions. And under the ESA 2010 national account revisions, quite a large part of that is going to get transferred to the household sector. So I guess in a year's time, this chart will look a bit different, and the household saving will be much greater, and the non-financial saving will be much less than we've been seeing. But certainly there's plenty of scope there for the non-financial corporate sector to invest and grow investment without actually having to borrow significantly, which helps to explain why a lot of the weakness you're seeing in bank credit in the UK on the business side is actually just really demand related rather than supply, I would argue. Anyway, when you add all these together, you get, of course, the current account on the other side of the equation. And the current account has been in a significant deficit, as you can see, running at a little over 6% of GDP in the last couple of quarters or so. And that's certainly a very big deficit. So I think if you had to really criticize the UK for one thing here, and what policymakers really need to focus on, it is this external imbalance, which is getting quite glaring. Of course, it's because a lot of money is flowing in. People want to invest in the UK still with its slightly higher interest rates, perhaps. I then thought, well, it'd be useful to break down the current account to see really what's driving this. And the dark blue lines, then you have the services surplus that's actually running quite close to record highs as a share of GDP of 5%. So it seems that reports of the death of the UK service exporting sector are rather greatly exaggerated, I would say here. The lighter blue lines show you the goods deficit, where the UK, of course, has always had a big one, and it's in fact getting, if anything, close to record levels here. We're running, as you see, around just over 6% of GDP there. And then you have, of course, the transfers, that's mainly EU contributions, running about 1% of GDP. And finally, what is very interesting is the swing that you're seeing in investment income. So investment income is the green bars, and you can see that those, of course, historically had been showing quite a nice surplus. But in recent quarters, as the UK, I think it's to do with the UK build-up of debt that's owned overseas, and also reduced return on the UK's holdings of foreign assets. that has swung actually into quite a big deficit. That's the most interesting thing about the chart, in fact, and that explains why the current account deficit has been deteriorating so significantly. And frankly, I'm not so sure that that's going to turn around a great deal. It looks a little bit baked in the cake there. So you have got some potential concerns on that side. In terms of the Bank of England interest rate normalization, well, it's a bit like the situation in some respects to the Fed, where you are seeing unemployment falling very rapidly in the UK, and I would expect that by next year we'll be getting close to the 6% rate for UK unemployment. So we'll be getting into the territory where people start talking about unemployment is equal to the NAIRU or the NARU, if you prefer that language. At the same time, we're not seeing particularly strong build-up of wage inflation pressures at this stage. And there's a big question mark, as I think Janet Yellen was mentioning yesterday, about what is really the NARU. You say NARU, I say NERU. And in particular, what the slope is, what is the coefficient with respect to inflation on it. So I think we're going to see a tightening labour market. What's a big difference, though, with the UK is that labour participation is rising very rapidly in the UK. So a lot more labour supply. And if you look at the numbers, it's actually down to old people. Even those aged over, I say even, those aged over 65, the participation rate has basically doubled since before the financial crisis. And you're seeing particularly strong rise in participation for the over 50s there. And that's reflecting really the financial crisis and demographics and social and secular trends. And that's very interesting. And of course, you're getting a more flexible labour force, I would say, one that is in a way more sort of, if you like, more easy to take lower wages, perhaps more flexible in terms of hours being worked. These are all some very important characteristics. So if we look at finally the UK earnings data, you can see that real earnings have been picking up gradually, not really flashing any particular alarm bells so far. In fact, just running at about a 1% pace, I would calculate. And you have there a series that the British Chambers of Commerce produce on recruitment difficulties. That's actually getting back now to where we were pre-crisis, which is, of course, a healthy sign. And I think you are seeing actually very really relatively low rates of unemployment now for those aged over 25. There's particularly been a significant fall there. So most of the unemployment in the UK is really concentrated in the 18 to 24 category, I would say. And we're seeing a significant reduction in long-term unemployment, which the government schemes may be helping there. Anyway, by way of conclusion then to this brief talk, I'd say that QE was highly effective in the UK, but it's very interesting to note that the UK does seem to have survived the tapering, which was rather abrupt in the Bank of England's case, quite well here. So there is life after tapering. I'd like to leave you with that warming message. As well, the UK fiscal adjustment is not over. That is very important. Effectively, I would say the last year and particularly the next year, it's all about politics, and so the fiscal adjustment plans are on hold here, but there are issues for the next government there. I've tried to illustrate why I think that this recovery has been very much driven by the private non-financial domestic sector, and that's been important. The export performance I haven't really dwelled on, but that's not been good. You could say the UK is in a neighbourhood where there's been a lot of weakness, so perhaps there are reasons there. And the next challenge really for the Bank of England is going to be to really determine what is the optimal path for interest rate normalization. I think something very gradual will be appropriate because there is still a lot of leverage around. And that leverage is predicated upon very, very low rates of interest. So you have to start thinking, in my view, about the change in a kind of percentage basis rather than the absolute change when it comes to raising interest rates and the consequences for for interest payments. Then the Bank of England can use other tools, and I'm sure Mr. Carney and his colleagues have got a nice toolkit. And I think when you have a nice toolkit, you don't want it just sitting on the shelf and never opened. They're going to want to use it, and it won't be long, I think, before we see the macroprudential tools to curb credit starting to be extracted. But also very important, as I mentioned, is the role of the exchange rate in terms of depressing inflation here and effective monetary tightening. And I think the Bank of England would probably be quite happy, relatively speaking, to use its macroprudential and the gradual rise in the value of the currency to provide the monetary tightening rather than start to change interest rates. But there's going to be an important communication message there. So thank you for your attention. Okay.
We're gonna let Julian go so he can get to his appointment. He'll be back this afternoon.
Yeah, sure.
So if you have questions, we'll tack him on for questions to the first panel after lunch. So now we'll move to Katarzyna Zadziorkowska. I'm just so happy I can say that name now. And is Michael Marisi in the room yet? Not yet, okay. But he'll be next. Thank you.
Good morning, ladies and gentlemen. It's a big pleasure to be here. Thank you for inviting me for this seminar. I will give you a completely different picture than what you already seen from charts, given that National Bank of Poland conducts very conservative monetary policy. So this is like back to fundamentals or back to the textbooks. And nothing as QE, all that stuff. This is pure macroeconomic policies like in the textbooks, which you will probably find quite interesting given the very interesting time we are living now. Well, let me start from very broad picture. Polish economy, which is probably quite surprising to you, did well, relatively well during recession. We were the only country in European Union that avoided recession. So we recorded the highest cumulative GDP growth over last 5 years. So you can see all other countries that they were less successful, or even they recorded a big drop in their economic growth. And there were number of factors that contributed to this success: balanced economic growth, floating exchange rate. I will focus on all those factors later. Public investments, so pure Keynesian case during recession, flexible labor market, and conservative, well-capitalized and profitable banking sector. I should also add that monetary policy has been well, for some was too conservative, however, was very successful in bringing inflation down. Since the direct inflation targeting has been established, we had a problem with reaching the target. However, starting late 2000, inflation remained more or less within the target, and just recently, as you can see from the chart, inflation dropped below the lower band of inflation target, and the latest figure is 0.7% year on year. I mentioned that part of that economic success was flexible exchange rate. This is extremely important factor given that Poland, as other countries, is expected to join euro area, and probably the question that you might ask is when Poland will join the euro and whether there is any target for that, and what are the recent opinions within the government and the central bank about doing so. It was extremely important that we stayed outside the euro area during recession from very simple reason. The exchange rate played a role of the shock absorber, and it supported economy because it, of course, depreciated during recession, and it spurred export. That was the driving factor during recession. So we might say that during this recession period in Europe, we had like one engine over two in the plane that was keeping the plane going forward. So basically, this was the effect of weaker currency. But also, we might say that by time coincident, we applied Keynesian policy to our economy. Poland joined European Union in 2004 and received the first package of European structural funds that ended in 2013. That was around 60 billion euros, and majority of those funds were spent on infrastructure. Now we got another financial envelope that is around 70 billion euros, and again those money would be spent on infrastructure mainly, but of course into other sectors as well. So you can see that during the period of severe recession in Europe, Poland received an enormous amount of EU funds that were spent on public investment and supported economy. Also, it's quite important to know, as European economy is very much dependent on credit, Polish banking sector is much less leveraged than Western economies, as very well capitalized and profitable. Of course, in majority is owned by the foreign owners. However, given the shareholder structure and ownership, which is mainly subsidiaries, it conducted very stable and reasonable policy. We haven't noticed any deleveraging in Poland during that period of recession that other countries in Central and Eastern Europe have noticed. It's also quite important to mention that our external position is quite stable. The current account, due to all those factors I mentioned, the inflow of capital and strengthening of export, tightened the current account deficit. So last year the deficit was around 1.2% or 1.5% of GDP. That was fully covered by the inflow of foreign direct investment and EU funds. So basically we might say that from that perspective the external position was very safe. As a result of those EU structural funds inflow, we accumulated an enormous amount of reserves. Polish reserves are at the level of $100 billion, which put us at the 20th position as a top reserve holders in the world. And it's quite interesting because our accumulation path was completely different than other banks in emerging markets, because we did it naturally. Because by exchanging those euros that were coming to the government from EU structural funds, we accumulated our reserves. Of course, it has an impact on our balance sheet from very simple reason. It is quite costly to accumulate more, because on our asset side that we have only foreign reserves, the return is, you can imagine what, given that we invest in core currencies. On the liability side, we have the cost of the sterilization of that exchange of the currencies, and the official interest rates in Poland is 2.5%. So we have a huge cost of sterilization, so more reserve going forward will be very, very costly. Of course, this is like buying the insurance. You have to take this cost if you want to be safe and protected. So, we, for the time being, we slow down a little bit the pace of accumulation of reserves, allowing government to go into FX market directly and to exchange those funds directly in the markets. But it doesn't mean that we will not return to further accumulation going forward. However, given the first panel, it's extremely important what other central banks around the globe are doing, because we invest primarily our reserves of course, in reserve currencies. So this has very direct implication to our balance sheet. As you can see from that chart, the economic policies help maintain low volatility of output gap. So in other words, business cycle in Poland is smooth relatively to other countries. Monetary policy in Poland and exchange rate helped to keep moderate volatility of inflation, and also private and public debts are relatively low and well below the thresholds set out in macroeconomic imbalances procedures and macroeconomic criteria. It is extremely important because if we are talking about our path to the euro, we have to fulfill Maastricht criteria. 5, the simplest one are, of course, that you have to keep your fiscal balance in check, like 60% GDP for debt to GDP, 2% for deficit, and of course low inflation, low interest rates, and stable currency. So given all those factors, we might say that we are very close. However, there are a lot of issues, and of course the devil is in details. I will mention about that later on. I also mentioned at the beginning that part of the success factor for the strong economic growth was flexible labor market in Poland. As you can see from the chart, the share of the temporary employees in total employment in Poland is relatively high. Of course, it looks very nice on chart, but it creates a lot of political pressure, and people want to feel more stable in terms of their hiring, and we have some, let's say, pressure from employees that this should be taken more seriously by the government, because people basically are concerned about the future, and also it somehow enables them to take credit, because of course banks, they request more stable hiring for granted long-term credit. Here is our latest inflationary projection. The central bank produces official projections 3 times per year. So the last one was in March, and you can see from that chart that the central projection for the GDP is that the growth in Poland will be around 4% going forward, so in the projection horizon. While inflation is expected to come back to the inflationary target, which is at 2.5%, the middle point of the target, because the target is plus minus 1.5% over that 2.5%. So we are not afraid of the European deflation, right? So we are not in the same basket of countries that we are afraid of deflation. We have a natural sources that will drive inflation up. So given that inflation is relatively low at the moment, there are several factors that they affected that lower inflation. Also imported, low imported inflation, but given that we expect rebound in GDP, we also expect that inflation will respond and will be higher going forward. Having said that, the central bank that cut rates to the historical low level, which is at 2.5%. No, 0, 2.5%, and for us this is the historical low level of interest rates. Also in the real terms, this is relatively still high interest rates, right? The central bank followed some other central banks, as this is like a new fashion, and wanted to stabilize the expectations about further rate cut. Introduce so-called forward guidance, which are like very simple version of the forward guidance. Basically, the aim was to stabilize the expectations, and said that interest rates should stay unchanged until, and it was like rolling, like with the QE story. It was rolled over the quarter and quarter, and current stance is that it should stay till the end of the third quarter this year. Yesterday, Monetary Policy Council finished their monthly meeting, and they decided to keep interest rates at that level, and there was no change in that, let's say, guidance. As the governor mentioned at the press conference, that the members of the Monetary Policy Council, they will be waiting for July's projection to see whether they will change, let's say, the bias or not. However, already we may say that given the monthly data, we already see that inflation this year might be lower than expected for this year, without indication for future, but this year inflation, while the growth might be a little bit higher than expected in March projection. Despite the fact that interest rates in Poland are at the historical low level, we do not expect that the credit growth will expand. Rather, I would say that despite all those factors, we think that rather the credit growth will be rather moderate, and there are other factors mentioned here, like tightening of mortgage lending standards. Basically, the biggest issue is taming FX lending and introduction of some macroprudential measures. We have still a relatively high stock of FX mortgage that is potential threat to households, but also to banks. They have to roll over the FX position, and also this creates a potential negative impact if zloty depreciates. Also, there is another external factor that plays important role, given that majority of the FX lending, mortgage lending, is in Swiss franc. As long as Swiss National Bank keeps the exchange policy unchanged, our household sector might be relatively safe. But if they decide to change the policy, then of course it will have impact on monthly payment of credit. I mentioned this euro area discussion. in order to join the euro area, this is not only that you have to make your homework. I mentioned the Maastricht criteria and other factors that you have to fulfill in order to be in the club. But also, given the current situation in the euro area, we see some, let's say, challenges on that front. There is a stagnation risk in euro area. There is some other institutional reforms going forward. We still don't know what would be the result of this fiscal banking union exercise, where we are heading, what would be the euro area 2.0 that we will eventually join. So there are a lot of questions here. Of course, there is also a big question in the short term about the situation in the euro area's banking sector, given expected asset quality review. So I would say there are not only like political issues and the homework in Poland that has to be completed, but there are a lot of clouds on the horizon. However, recently another factor appeared in this political discussion about the euro entry, which is the Russia-Ukraine conflict. And it opened again the discussion about whether we should speed up our process of euro adoption. Maybe this will like keep us safer if we are in the club. However, it was not like picked strongly by the Prime Minister, and I would say we are in the situation because the central bank has only advisory role on that front. That we will, of course, wait for the government's decision on that. In terms of, I mentioned that in terms of the fiscal situation, we are now in the consolidation path. We are obliged to cut the deficit below 3% already next year. So based on all expected reforms conducted by the government, it's likely to happen. The public debt reduced by around 7% of GDP, as you can see, to the level of around 50% of GDP. That it was an effect of a change in the pension reform. Half of the assets that were held in the private pension funds were transferred to the public pension fund, and we have only contingent liability in exchange. But as government is explaining that operation, it was extremely important to give Poland a fiscal space to absorb more EU money. As I mentioned at the beginning, Poland is committed to receive around 70 billion euros in the second financial envelope that will start this year and will last for 7 years. And the majority of those funds would be spent on infrastructure and on the public investment. So in order to absorb those money, we need to co-finance all those investments. The ratio is 1 to 2. Basically, it means that for every euro, we have to half of the euro co-finance. So basically, it means that in order to absorb those money, we need to spend more. So in order to spend more, we need to have a space to have a higher, to allow for higher debt. But there is a very important figure here. When we changed the constitution in 1997, we put a very strong anchor or the brake to the constitution that the debt cannot exceed 60% of the GDP. Basically, it means that in Poland, it is impossible that the debt will be higher than 60%. So, given that it's impossible from the political reality to change the constitution at that moment, basically, and if you want to take this chance and to spend those money on infrastructure, so to absorb those money, because we believe that this will be the last EU package that will be so generous. So basically, we need fiscal space to absorb those money and not to breach this 60% of GDP. So this is very important because many market analysts, they perceive this pension reform change as a kind of nationalization of assets and something like hidden or the conspiracy theory behind that. However, this is as simple as that. The fiscal space was needed to absorb those money, to invest them, and not to exceed 60% of the debt. So, to sum up, when I was thinking about summing that presentation about putting upside risks and downside risk, I realized that there are more on downside rather than upside. So then I deleted this upside because basically it looks like we have pretty stable and balanced picture of Polish economy. And in terms of the local factors and domestic economy, there are no major risks. Elections, parliamentary elections are next year, and the polls suggest that the current ruling party might win elections. We will we will have higher absorption of EU funds that will translate into higher public investment. CPI will return to the target. Unemployment is relatively stable. Employment is rising. So very healthy picture. So what is the downside here? And the downside risks are mainly outside of the external factors. First of all, as I mentioned, we are a little bit concerned about this exercise that the EBA will conduct later this year, this asset quality review. Some Polish banks will be exercised, but we are not concerned about our domestic banking sector, but we are concerned about the mothers. So this is the number one concern, because given that the banking sector is so leveraged in Europe and some let's say, skeletons can go out from the closet, and this might affect the deleveraging process in Europe, then it might, of course, affect banking sector somehow in Europe, and then via this real economy channel will affect Poland, because Polish main trading partner is, of course, Euro area, not, as other people think, Russia and Ukraine. But as I mentioned, those two countries, of course, there is a threat of further developments or the escalations of political tensions between those two countries. There is, of course, the direct implication of that, because we have 5%, I think, share, the export share to Ukraine, and higher, like 7-8 to Russia. So we have already noticed the direct implication of lower export to those countries, and we don't know what would be the outcome of that situation. So of course it might also affect further the export side. Again, we are concerned about that also from that angle, that, for example, those two countries mentioned are also a strong or the large partner for Germany, that is our key partner. So, so we don't know how strong is recovery in the euro area. And again, all those discussions about whether we should weaken the punch or to change the monetary policy, and how this would affect the global economy, and of course situation in other emerging market countries, mainly China, how this would impact the global economy. Thank you. This is what I wanted to say.
Okay. We're going to bring up Michael Marisi, who's going to talk about Eastern Europe emerging markets, and then both Katerina and Michael will take questions after.
Thank you. It's wonderful to be here today, especially to follow Katarzyna, who represents the best of central banking. At the end, we protect the value of your money, we protect your wealth, we protect the income distribution. So it's good to see that we have central banks that have such valuable roles. I just flown in from the U.S., and I apologize, I arrived a bit late. There was a problem getting here. But I spent 2 days in Washington, D.C. going over Ukraine and Russia, so I'll also have a few things to say about that. Okay, it's this way, sorry. So on the first page, I just want to make a few points. Basically that the perceptions of emerging markets have changed. I think you all know this, but I'll just go over some of the reasons. And emerging markets now are seen as significantly more vulnerable and dangerous than they were 18 months ago. Now that statement that I just made is wrong, because this group of countries called emerging markets isn't a homogeneous group. So what you have are emerging markets like Poland, Mexico, South Korea that are considered high-grade investment opportunities. So sovereign wealth funds, central banks will buy, say, Polish bonds unhedged because of very good risk and because there's that level of economic professionalism. So what we have in the very first bullet point is that if we look at the region that our group covers is 41 countries, everywhere from Iceland, Israel, to Ivory Coast. That group as a whole has been downgraded in terms of growth prospects. So at the beginning of this year, for this very big region, we had 2.9% growth, and now we're down to 2.2. Well, it's in part because Turkey has had to raise rates much more than we originally expected. It's true also that South Africa, the mining strikes have been longer. And then there's this problem between Russia, Ukraine, the EU, and the United States. So all of those factors have been negative, but euro area growth has been higher than expected. So we're saying euro area growth this year is going to be 1.4%. At the beginning of the year, we thought 1%. So we've upped our growth forecast for Poland, for Hungary, Czech Republic, etc. The second point I'd like to make is that last year, in 2013, if you were invested in emerging market fixed income, you lost a lot of money. Well, anyone in fixed income lost money, but a lot. But this year, you've been doing very well, and that's where this year, there's a differentiation between high grade and high yield. So again, perceptions of EM have bifurcated. You now distinguish between high grade and then high yield countries. Now the second point I'd like to make, and that's the first 4 bullet points, which I know you can't read, but you'll get copies of this, is that the investor base has changed. So again, first point, concern about EM generally. That concern has led to the differentiation between EM high grade and high yield. And the third point is the investment base has changed. What do we have? We have many fewer benchmark investors. We have many more crossover investors, and local investors have become more and more important. So in a country like Poland, you're going to see the pension funds growing. You see the mutual funds growing. And so we have to know our local investors in Poland. With regard to the benchmark investors, they took heart. They lost money last year. It was much greater than they expected. And on the whole, they fled the asset class. So you're roughly down 20%, roughly, from where you were mid-May last year. And then crossover are more discriminating, and they really cherry pick. So they're not going to spread money in the asset class as a whole, they're going to cherry pick. And then you have what we call our strategic investors, and the strategic investors are under-allocated in emerging markets for traditional reasons. So they would include your global insurance companies, some of your global asset managers, sovereign wealth funds. And what they've been doing is over time, they've been moving their allocations up. And this has been very steady. This year happens to be a bit late. So what we see when we look at this group of investors is they pay more attention to idiosyncratic factors. So the idiosyncratic factor of the day is Putinism, right? President Putin has decided that he has a vision that very few of us understand. And this vision could disrupt European and global growth. So from an asset class perspective, not from a geopolitical perspective, we've seen our crossover investors tell us Russia is not worth the risk. Full stop. We don't care about those macroeconomic tables you have. It is not worth the risk. So they'll be out of the asset class for a while. And who benefits? Well, actually, Latin America has benefited. Poland's benefited, right? Hungary's benefited. Slovakia has benefited, even though it's not an emerging market. And Slovenia has benefited. So peripheral Europe has benefited. What I would say now, when we think about reasons to remain cautious about EM fixed income, one, eventually, the 10-year U.S. Treasury yield may go up. We keep on saying it's going to go up to 340, but I don't think anyone in the world believes our 10-year forecast for the end of this year. But this issue on Ukraine, U.S., EU, and the G7. Now, there are really two aspects to that. And one aspect is further sanctions, and the other aspect is a potential disruption of Russian exports of natural gas through Ukraine to Europe. So we've been in touch with the Russian officials, and they have some material which they published in the latest IMF review of Russia, in which they explain what could happen. So when we think about sanctions, we're in a difficult position because there are many countries, such as Poland and the Baltic countries, Romania, and to some extent Finland, that really perceive the new Putinism as breaking the rules of the game in a way that could lead to greater military expenditures in a new Cold War. And then you have the United States, which tends to be a bit on the hawkish side. So there's an attempt to coordinate sanctions, and so far, these sanctions, according to investors and according to the popular press, have been light, okay? Light. What does it mean? The first set of U.S. sanctions include Bank Russia. Is this, do we have journalists here? Good, okay. So I just have to be careful when they're journal. Pardon me? Off the record, okay. So Bank Russia essentially was a family office. And it was a family office for those close to Putin. So yes, it had international implications. The next two banks that were sanctioned were smaller banks. Some international implications, but on the whole, nothing earth-shattering. Until yesterday, there was a sense, and we went through with sanctions experts in the government, National Security Council, we went through with everyone, what the next sanctions were likely to be. And they were likely to be in the financial sector. So there was a sense that those financial sector movements would have an impact on global financial markets and could slow growth. Okay, that's pretty clear. There's lots of wrinkles about the U.S. going one way. Europeans can't agree. the U.S. has personalized the attack on President Putin and those surrounding him. That's been a bit distasteful, but what can you do? It's politics. Now, the second has to do with the potential disruption of natural gas exports to Europe through Ukraine. So from the Russian point of view, if the Ukrainians are not paying their bills, then there's a high likelihood that they could disrupt those exports. So what the Russians can't do, they can't sort of send gas through Ukraine in a way that Ukraine couldn't siphon it off. So that's why they have to, if they're going to penalize Ukraine, they've got to penalize Europe. So let me give you some numbers, relatively straightforward. $2.2 billion of arrears Naftogaz, which the Ukrainian gas company owed Gazprom at the end of March. And estimates are that those arrears will be up to $3.8 billion by the end of May. So if Naftogaz can pay the $3.8 billion, there should be no problem. And it's possible because Ukraine just received a IMF program, and if you add up what the World Bank has said it's going to do, U.S. money, et cetera, you get to about $5.5 billion funding by the end of June. So there are ways in which they can make it work. The key to the macro view, quantitative easing, ECB policy, depends on whether Ukraine loses territory or not. That's how I would summarize it. So yesterday, President Putin in the afternoon changed his mind, which was very kind of him, and he no longer supported referenda in two of the eastern oblasts or regions of Ukraine. Those regions would have allowed the people in those two areas to answer the following question. Do you support the creation of an independent and sovereign Donetsk Republic? Do you support the creation of an independent and sovereign Lugansk Republic? So if those referenda had gone through, many people thought there was a good chance that Ukraine would have lost territory. So the fact that that hasn't occurred is encouraging. Okay, now I'm going to go on to other issues, and I'm going to take questions. Let me give you the global picture. And what we see on the U.S., we're talking about this year growth has been a bit disappointing, and I would like just to point, instead of going through all the numbers, point to two puzzles for the United States. So the first puzzle for the U.S. is the labor force participation rate. And that's had fallen this past reading to 62.8. And that fell from 63.2. But if you read Fed papers all last summer, and if you follow these Fed papers, which usually are very well written, you saw that the Fed, in their scenarios, had 63.2 as sort of the most discouraging scenario. And then they would have scenarios at sort of 63.6, 63.8, 64, whatever. So it's very hard for us, our research group, which has many good economists, to figure out why. So that's the first puzzle. And then the second puzzle is more subtle. So there's research by Mark Watson at Princeton and Robert Gordon at Northwestern and JP Morgan's Michael Feroli, which show, and this is confirmed by people now in the Obama administration, that if you do the econometric analysis, whichever way you do it, you see that the short-run unemployment rate is a better predictor of the Phillips curve, of the relationship between slack in the labor market and prices. So luckily, that short-term unemployment rate has risen a bit, so it's now at 4.3%, so that's a lucky point. But the more major issue is that not only has J.P. Morgan and most forecasters lowered potential growth in the United States, but the Fed is also. So if potential growth is significantly lower than it would have when we thought it was, say, 2 years ago, then the slack in the U.S. economy is likely to be much less. So there is a bit of a contradiction between that growing awareness and the attitude of the Fed. Now, if we go to the euro area, again, I have lots of things about the euro area, but the key to the euro area is this last point, which again, you'll eventually be able to read, and it's youth unemployment. Youth unemployment. And I know the ECB doesn't have a mandate, but Europeans will be focusing on this. Number one issue, number one puzzle. So the latest euro area youth unemployment rates, these are harmonized rates, so as comparable as you can get. Germany, 7.7%. Austria, 9.4%. Netherlands, 11.5%. And then let me skip a few. Euro area, 23.5%, and France, 23.6%. So Germany, 7.7%, France, 23.6%. Big difference. And then you go to Portugal, 35%, Italy, 42.3%. I benefit from that. I'm of Italian heritage. I benefit. All the Italians have been coming to London. There's better Italian food, better service. I benefit. But it's not good. It is not good for that generation. And I'm going to tell you a personal story because this young lady really has made me a very happy individual. So my wife and I go to this place, and there's this, very charming young lady, and she is super educated, right? Bologna, 1 degree, Bologna, master's degree, internship. I mean, this is a super intelligent, super educated lady. She's come to London, and again, she's made us happy because she's a wonderful hostess and organizer. But that's what, I hear from so many of my friends, that their kids have come to London to take jobs that they were more than qualified for. So this is going to be the key there. Now we go on to Japan, and Japan has the most creative macroeconomic policy we've seen in a long while, and some of it's good. Right? Inflation, for one reason or another, you could talk about core, everything, but it's gone up, and growth's gone up a bit. But we haven't seen the third arrow, the structural reform. So that's the puzzle there. What will these structural reforms be? And then we come down to China, and China has a lot on its plate. And when we think about what it has on its plate, it wants to maintain growth in the sort of the 7.5% range. It has this pro-reform initiative because it realizes it has a shadow banking sector that is dysfunctional. And part of that dysfunction is the way in which local government projects are organized. But the main issue, the main puzzle now for China is that China realizes that the shadow banking sector has to have its air taken out of it. And they've done that on the margin. So on the margin, you see that lending from the shadow banking sector is about 50% of all new lending. And last year it was 60%, a little over 60%. So on the margin, it's coming down. But the way they're going to take the air out of the shadow banking sector is to have selective defaults. And so this sounds good. If you're a magician, it sounds good, but it's a bit dangerous. So the selective defaults, as you all know, how does the shadow banking sector work? It's very, I'm going to simplify it. So in the official banking sector, the interest rates on your deposits are capped. And so you're going to get an interest rate which is well below inflation. In the shadow banking sector, you can get interest rates in the range of 9%, say 9%. And then they lend it out to SMEs generally at, say, 13, 14%. So as long as those SMEs pay back the shadow bank, no problem. But when they start to fail, then either government or one of the state-owned banks bails out the depositors are actually owners of these trust products, or their defaults. Okay. Are there any questions at this point because I have a presentation that goes on a bit. Are there any questions? Okay. So first page just tells you U.S. household sector actually looks pretty good, and it's looking stronger and stronger and stronger. Next page tells you some of the euro area problems have disappeared because even peripheral European countries have current account surpluses. So again, this is sort of if we're talking about central banks, this is a bit of a problem for the ECB because you have Germany with a current account surplus of about 7% of GDP, and peripheral Europe, so that's Greece, Spain, Portugal, Ireland, Italy, with a current account surplus of approaching 1%, and the whole euro area at 3%. So it's a bit hard to have a weak currency. And then you have this issue which Katarzyna was mentioning. European banks haven't delivered yet. They've been delivering, but they haven't reached sort of the goal they'd like to. And this asset quality review of these 128 banks is likely to be very serious. So it affects all emerging market central banks in Central Europe. Okay, this is the energy supplies issue I mentioned earlier, and this is the impact of oil prices and energy prices on EMEA countries. And then here we have all regions, all countries growing below potential, almost all. And then this is an interesting graph here, which you'll be able to read later, is that there has been a lot of deleveraging among countries. Now, the United States, at the very bottom of the chart, they had household debt to GDP at the end of 2008 at 96.2%, and now it's 76.7%. So they've delevered over 18%. That's a huge amount. And then you can see that Hungary also has delivered a tremendous amount, 9.1% of GDP. So again, very impressive. And Poland, you've seen the household debt increase, but at roughly half the amount that you saw in Brazil and 1/3 the amount that you saw in China. So this little table just gives you a very imprecise way of looking at potential problematic areas. And the one that stands out is Malaysia. So their household debt to GDP is actually higher than the United States right now. So they had this huge increase from end 2008 to the latest figure, which for some countries is end September, others it's end December. And here we have movements in real and nominal inflation rates. And this has been problematic. Let me focus on Russia. So Russia, before the problem with Ukraine, the Central Bank of Russia, which has really excellent management, had said to the markets, in 2015, we are going to move to serious inflationary targeting, and we're going to focus on that, and we're going to have a much more flexible exchange rate. Now, before they wanted to get into that new regime, in my opinion, the central bank leadership said, is our exchange rate appropriately valued? And there's a zillion models out there. We all know the models. But if you just look at that ruble number there, that since the beginning of 2004, the ruble's appreciated in real effective terms over 46%, and since Lehman, 3.4%. Well, that 3.4% has come down 10 percentage points over the last few months. But what you had in Russia, from a macroeconomic point of view, is a central bank leadership that sent a message to the population that we're not going to protect the ruble, and we think the ruble is overvalued, and the population began to move into cash dollars and cash euros, and then the deposit mix began to change. So it's unfortunate for the central bank, and it's a little more complicated because they also have problems with the quality of some of their banks, and they've been taking licenses away from banks. But this is an issue for some countries. Now, it's not an issue for Poland. Katarzyna, I apologize for picking on you. So Poland, since Lehman, the zloty has depreciated 12.2%. So this is not an issue for Poland. And then this has to do with external financing needs. And here we have a chart. And again, when you get the presentation, you may want to take a little time on this particular chart. So when I go to see the Bank of Japan, the Bank of Japan only wants to spend 1 hour talking about this chart. They don't care about the rest of the presentation. We just talk about this chart, what it means. And what we can see here is that Greece, in the middle of the page, right now it's end 2014, general government debt to GDP ratio is 176%. Now that is after various types of subsidy and a debt forgiveness or private sector and public sector buy-in of well over 140% of GDP. So you have a picture of how much it takes to get a country out of a debt situation. Now, Portugal, we're up to 126.7% of GDP, but they have a bit of a primary fiscal surplus. They've been able to change their unit labor costs. So there are a number of things that are positive. Now, getting back to the quality asset review of banks, so these 128 banks, the ESM, European Stabilization Mechanism, has 60 billion euros that are a last resort, and that would be direct capital injections. So for much of the recapitalization needs, first you go to the private sector, then you go to the public sector of that individual country, but that would increase your general government GDP. And then the third element is the European Stabilization Mechanism. But they would take equity positions in the banks. So while on the whole, I'm sure National Bank of Poland, JP Morgan, we're all concerned about these asset quality reviews, we'd say the following, JP Morgan would say the following. One, the asset quality reviews have been going on since mid-last summer. A lot of money has been put aside. Private sector has already been contributing more and more to the capital of the banks. So even though there could be a hole of, say, 100 billion euros, maybe a bit higher, we think this is very much a doable issue. And then we look at just our growth forecast, FX assumptions. And here on page 18, what we see is that there's been a great deal of deleveraging. So for a country like Hungary, it had loan to GDP ratio 151. Now it's down to about 105. So we go through it country by country. And then we talk about the adjusted basic balances of these countries. And this is a point that Katarzyna was making. This last 7-year program is likely to be the last huge generous program for Central Europe. And so that has a big impact on this adjusted basic balance. So for instance, if we take a country like Poland, we look at the end of 2013, we have a current account deficit of 1.3%. And then within that current account deficit, there is about 0.7%, which were certain transfers from the European euro area that come in the current account. So the current account itself was lower than it would have been. And then you have capital transfers for Poland at 2.3% of GDP. So that's a net increase, which covers more than the current account deficit. Okay, and then let me get to this last point. Now, this is the fresh data. This is not tainted with JP Morgan methodology. This is all Eurostat data, so it's as comparable as you want. So if we look again at Poland in 2005 on the left-hand side of the chart there, you'll see that Polish labor cost in the manufacturing and business service area was about 22% of the euro area average, and by 2013 it went up to 27%. Now, if you then factor in the level of productivity, so you get something on the right-hand side called the labor cost adjusted productivity, or 1 over the unit labor cost, then Poland continues to be an attractive place to invest on this one metric. It has 1.93 of the euro area average. So almost double. And that's one reason why you still see all this foreign direct investment in Poland. Hungary does pretty well too, a little above that, and you can go on with countries. What's interesting is we also put in Portugal 1.4. And Portugal has come up, according to these statistics, tremendously. And Greece, 1.37, okay? When we did this in 2010, where was Greece? It was exactly with Germany. So Greece has also changed. There has been structural reforms. I'm not sure how far I should go on. Do you take questions in this format, or how do you do things? Should we go over there?
Yeah. We'll take a couple of questions. We're eating into our lunchtime period, but we lost a speaker in our next session, so I'm going to cheat and move everything forward about 10 minutes. We got our first question over here. Please wait for the microphone so we can get it on tape.
My name's John Whittaker. I'm from Lancaster University here in the UK. A question for our Polish lady, if you don't mind. It's a bit technical, but administration of interest rate, transmission of interest rate choices from the Polish Central Bank. You mentioned that your central bank assets consist largely of foreign assets, which earn rather little because they've got there from the structural funds. Well, actually amazing that that structural funds amounts to so much that it makes that difference. Then your liabilities presumably earn rather little. Your liabilities cost you a great deal because presumably those are deposit from the banking system. In which case, then it rather looks like the Central Bank of Poland is operating at a loss. But then that's the result. The result of that will be transfers to the banking system. So there's nothing leaking out of Poland. So you sort of implied that this was a bit of a problem for the Polish Central Bank. I don't see quite how it is. Just a second sort of added bit onto that. You've done very well in terms of GDP growth and so on. Being outside of the euro, I just wonder the extent to which your good inflation control is a result of expectations that you will sometime join the euro. And, perhaps it would be a jolly good idea if you didn't join the euro, nevertheless. Please, that's what I want to answer in one go.
Should we collect questions or just answer? All right.
Have at it.
All right, so to answer the first question, yes, indeed, it's quite challenging to be at the central bank at that moment, given the asset liabilities management, because as I pictured, basically 99% of our assets of the central bank are foreign assets. So expected return is, you know what is the expected return if you invest in core currencies and you are conservative central bank and you have very conservative credit risk as well. So basically there is first limited space of investment that I can pick up first, and second, the return is quite limited. What's even worse, I should add, that side of the balance sheet strongly depends on the situation on the local exchange rate towards all those currencies, because if zloty appreciates, basically even if I have excellent, if I'm excellent asset manager and I really deliver a profit in current currencies, basically the zloty appreciations will eat all this profit. So what I can count on is the depreciation of the zloty, but as a central bank, I should not expect depreciation of the zloty. And given that we have adopted the fully floating currency regime, we don't care about exchange rate volatility. I mean, whether this is appreciation or depreciation, if it's still in terms of the how we call it fundamental values. So on the liabilities side, of course, the biggest cost that we have at the moment is that we sterilize all those exchanges fully. So basically, we bear the cost of 2.5%, which is the open market operation. So we issue bills to the banking sector that are priced at the level of 2.5%. So this is given relatively huge over liquidity of the banking sector. This is a huge cost to the central bank. So again, I shouldn't hedge myself against the Monetary Policy Council. So basically, I have this cost on my balance sheet. So again, this is a situation that not only Polish central bank but other central banks have, and for us, it is extremely important to come back to the new normal in the new, I'll say, in core currencies or the core countries. So it's extremely important. Second, about inflation and expectations. I would say that inflation expectations are disconnected to the euro, to euro entry. Based on recent polls, people are not so enthusiastic about joining the euro. So this is less than 50% that they would like to see Poland in the euro area, while the inflation expectations are well anchored around the inflation target, which is at 2.5%. So I would say there is this connection between the euro entry and inflation expectations.
In the back of the room, Joe?
Puma Kimis from OMFIF. Mike, I thought you made a really good point on youth unemployment, and I'd like to explore the idea of international institutions, or I should say sovereign wealth funds. How far do you think these public institutions, quasi-public institutions, could help stem youth unemployment? We see that in the Middle East, in Asia, sovereign wealth funds like Khazanah have domestic focus with labor interests as well. So how far do you see that taking place? The Italians have the Fondo Strategico Italiano, for example. So do you see this taking place? The Poles, obviously Cartagena, the PGK has a bit of a development focus. So how far do you see sovereign wealth funds playing a role in youth unemployment? Thank you.
Thank you. It's an excellent question. I'm going to answer it in 3 stages. So first stage is EIB, European Investment Bank, has been recapitalized, and that recapitalization about 60 billion euros, and that means they could invest in the range of 4 times that amount of money, maybe a bit more. So they have experts, and I've spoken with them in particular about Italy, about infrastructure projects in Italy. So I'm of Italian heritage. I work for a bank that has a lot of Italians. So after I hooked up with EIB, I got all of our high-level people. And this is an ongoing process. And when we spoke, it was a year and a half ago we spoke. And I wanted something that would be realized in 5 months. And they're talking about 5 years. So I think this has started roughly 1.5 years ago. And we're into the process. And there will be these infrastructure projects which will be funded by investors worldwide. And that could include sovereign wealth funds, because it's overseen by the EIB, it's public-private money, so that's one. The more creative issue, which you've seen in the UK and you've seen in Hungary, are various loans for growth schemes. And Katarzyna, correct me if I get this wrong. I'm sure you will. You'll be kind enough to correct me. Okay.
Yes.
Okay, so the key to these loan for growth schemes is you'd have a central bank that would say, lend money to a commercial bank or private bank, or state bank at sub-market rates. So in Hungary, they lend it out at 0, and then the banks on-lend the money at a low rate, and I think they on-lended at 2.5%, so there's 2.5% margin. And then you have to have the fiscal authorities provide some lender of last resort backup. So insurance that if the banks lose money on these, loans, then the government effectively will pick up some of the first losses. Now, what we haven't seen yet, we haven't seen any, the Qatari sovereign wealth fund or Abu Dhabi sovereign wealth fund. We haven't seen any sovereign wealth funds engage in programs in any country designed specifically to encourage employment of young people. So they could be internships, there could be conceptually programs of that nature. So right now, what we see is loan for growth, that's clear. Let's see. Oh, no, EIB, loan for growth. Oh, the third thing wasn't this more creative idea. The third thing is that the national central banks in Europe are looking at ways to lend to SMEs. But it would be something like the loan for growth scheme, something like that. Mm-hmm. You want to add?
Yeah, if I may add, because we do not have that kind of first program that I mean the on lending for youth programs or internship, whatever. There are like intergovernmental works about how to support youth and after studies population with some kind of let's say support, which is not only money. But in terms of the SME, this is now on the agenda of European leaders, how to support that particular sector. As I don't know how this is in the Western economies, but in our region, that sector had difficulties to obtain funding for and financing from banks. They were scored with much higher risk, of course, so the funding was, the financing for them was extremely expensive. So now there is a lot of attention and programs, particularly in Poland, how to lower the cost of financing for this sector, as this sector generates a lot of GDP in Poland.
So the Poles have come up with a creative idea. It's called the Polish Bank for Reconstruction and Development. And the Polish Bank for Reconstruction and Development is designed to encourage public-private partnerships and mainly infrastructure investment, which has a large employment content. So that's one of the reasons that the Poles extinguish 7% of government debt, essentially. That's another reason.
All right, thank you very much. We're going to break for lunch now. We'll come back in 1 hour, which will be at, all right, we'll come back at 1:45, and we'll have our next panel on international. Thank you very much.